Hey everybody, welcome to Cincinnati's best ever real estate investor mastermind here on Zoom, the last Tuesday in April of 2020. My name is Slocomb, and I have here with me Kurt Weil from Ziffel Capital and Jered Sturm from S&S Capital Solutions. Did I get both of those correct?
Close. Mine's S&S Capital Group.
S&S Capital Group. Sorry. We are going to have a conversation here about how COVID-19, shelter in place, and the greater economic factors surrounding this pandemic are affecting Cincinnati real estate. This is going to have a bit of an emphasis on apartment investing, whether that be 2 to 4 families or much larger properties. Kurt, why don't you tell us a little bit about your story?
Thank you for having me on, Slocomb. My name is Kurt Weil, as you said, with Ziffel Capital Partners. We're a local brokerage firm here in Cincinnati, located in Hyde Park. We serve residential and commercial mortgage groups. So I am residentially licensed, but I do have a focus, and majority of my background is in commercial lending.
Nice.
I do focus primarily on multifamilies. Investment properties is the majority of what we finance on the commercial side. I joined Ziffel in late 2016 and have been there helping to develop the commercial arm, arming ourselves with a multitude of lenders. We work with over 30 lenders locally, and I would say now over 50 on the national platform of everyone from life insurance companies, CMBS lenders, Freddie Mac, Fannie Mae, to SBA loans, which is a very hot topic right now given COVID-19. PPP loans have kept us very busy, but also we do residential loans, specializing on the jumbo side, whereas most of our clientele when Ziffel Capital started was for business owners who had a harder time getting residential loans, being Schedule C or having K1 type income that wasn't your normal W-2 type income. So we turned to a lot of portfolio lenders that were more lenient and understood that. That's kind of what led into my transgression into Ziffel outside of banking, to help with that gap and bridge into more of commercial loans. Prior to that, I was in the banking world. I actually underwrote commercial loans for a couple different banks and syndicates, but I did primarily focus once again on multifamily, investment real estate, industrial flex type office properties. So that's pretty much my background.
You're also an investor, though. I know you have.
Yeah.
I know you have some properties here in Cincinnati. You want to tell us a little bit about that?
That's right. I'm a born and bred West Sider, so of course I like to invest on the West Side as well. I have some multifamilies, a lot of quads, more so than anything, a couple single family homes, and I partnered up with a couple guys on some larger 150, 170 unit projects, that kind of trying out the whole gamut, because one thing that I understood inside banking was every banker is going to tell you what your expense ratio should be or what your load should be and what you can do and what you can't do on turns. But I like to say, I walk the walk as I talk the talk, because most of them don't actually invest or self-manage their own property, which is a whole different ballgame.
Nice. Thanks, Kurt. Jered, tell us a little bit about yourself as well.
Yeah, thanks for having me on as well. But I'm an owner-operator here in the Cincinnati market. Anything from single families to large apartment communities. The focus now is on large apartment communities, but as our company has grown, it has grown from single families to large apartments. So we still own some of those smaller assets, and just focused on owning and operating those. And that's the only real true arm of our business, is just being a quality operator and investor.
Gotcha. I'll have several questions about that here soon. For those of you who are listening and watching in, thank you for coming. Thank you for checking us out. A couple of quick things about this Zoom call. We will be using the Zoom webinar chat, specifically the everyone chat. if you have questions for Kurt or Jered or me, I will be making note of your questions, getting them saved in front of me in my notes here so I can make sure they get asked at the appropriate time. I have a flow for how this is going to go. Great. So, Kurt, let's pretend that there are people who are listening in or watching this who don't know how forbearance works, but they've heard that buzzword come up several times. They've been thinking about it possibly for themselves. What's a quick summary? What do people need to know? Where can they go to get more information?
Sure. There's a lot of websites you can go to and a lot of research. Right now, with as prevalent as that is with the COVID-19, typically the lender that you're with will have a really good synopsis on their website of qualifications, what does it mean, pros and cons. In synopsis, right now on the residential side, if you have your own personal mortgage, if it's a government-backed loan, a federally backed loan, which majority are because they get sold off even though your bank still may service it, your forbearance is due to hardship. So that being, if you got laid off, if your hours got cut and you're substantially making less, if you have long-term health issues that employer insurance won't cover, something of that nature, you can apply for a forbearance. Right now, the rules on forbearance are you can go out to 12 months, but what people need to understand is that it's 180 months. And then you have the ability to renew or extend for another 180 months. So you can go out to a year.
180 days?
Yes, 180 days. Thank you.
Gotcha.
180 months. I'm sorry.
Not 30 years.
Yeah. That's what happens when you when you're booking a 15-year mortgage right before this, and you're going there. But yes, you're right. 180 days. So it's 280-day cycles. It can go out to a year, but in essence, a forbearance is you have a multitude of different options, really, and with that, there's pros and cons with each, and your banker should be able to tell you that. But what it comes down to is you're offsetting your payments by paying them back later somehow, some way. It either gets tacked on to your loan balance, whereas if you have a 30-year mortgage, it may become a balloon instead of on your 360th payment of being paid off. Or if you skip 6 months, they will work something out where, hey, you skip 6 months, now that you're back in your job and making money, you can we can slowly add a little bit to each payment to get you caught back up. So there's different options. A lot of different lenders will work with you on that.
Kurt, those are not the two options I've heard about the most. What I've heard about the most often, and what I suspect the people listening have heard about, is either payments being added to the end of the mortgage so that it's just not fully amortized and paid off until 6 or 12 months later. I've also heard that there are banks that are requiring that the principal and interest payments that are forbeared, whatever the word is, that as soon as the forbearance period ends, all of that money is due. Just to put a button on this,
well, and that's
a way for me to figure out which of those options are available to me, what my lender is going to let me do.
Well, and this is how I understand it, which, a lot of times with these programs, things change, such as like the PPP, the second round, rules are changing. So from what I understand as of today, from what I understand from my lending partners, is that asking for the whole thing to be due, all those payments, the moment that your forbearance period is up, is no longer a valid option. From my understanding, banks are allowed to do that. They're providing additional options of being able to spread it over future payments, or like you said, at the end of the loan, what would look like a balloon note, or essentially you're tacking on an extra 6 to 12 payments rather than having, what would be on a true amortization cycle of 360, more like 372 if you had 12 months of forbearance. So you are correct on that front. But as for My understanding as of today is they're saying you're not allowed to ask for that total principal and interest 12 months recapture the day the forbearance is over.
Gotcha.
Yeah.
With regards to the payroll protection program and SBA loans, let's say that I'm either a full-time real estate agent or I'm involved in real estate investing full-time as a transactional investor like a flipper or a wholesaler, or as someone who's buy and hold. If I am feeling a crunch right now, what's the best route for me to take with regards to those possibilities?
So a kind of little background on the SBA, Small Business Administration. It's really set up for true owner operating businesses that, and don't get me wrong, I understand the investor question, a flipper, that is your business. I completely understand that. I hope to make my investing my full-time business someday as well, but it's hard to qualify. You have to be very, very accurate. You have to be really good with your numbers. But with the payment protection or with the payroll protection program, what you have to understand is that 75% of that money has to be used for payroll. So 25% being able to be used for utilities, things like that, not just basic overhead.
Can I say that paying my contractors on a 1099 basis is my payroll?
That's a good question. That's where you start to get into a fine line of will they accept that? The issue that you have is that when you look at the PPP for the application, essentially what they do is they go back into your business over the past 5 months, and they take your payroll off of those 5 months and multiply by 2.5 to get you to your annual. And that's how they come up with the amount of money that you get. To be able to keep it and for it to be forgiven, that's how you get to you have 75% of that money has to be dispersed over the next few months as payroll, and the remainder towards fixed expenses such as utilities or rent or mortgage payment or something of that nature. When you get to, say, for example, Jered has, maybe he has a subsidiary of S&S management company, right? Where like it's just a management team where he employs 10 people who get a monthly salary. So Jered can apply for this where he takes the past 5 months that payroll that he paid them, do his formula, get approved, and use the money to pay him over time if, say, his properties are just making the mortgage payment and he can't pay that management fee per property. That's really what it's more so set up for. Unfortunately, the first round, there was a lot of companies that took advantage of that, not to mention any big name Shake Shack. But, they took the money and they knew they weren't actually going to use it for the right reason. And when you don't use it for the right reason, it's not forgiven. It actually becomes a very low interest rate loan, but it comes on your balance sheet as a loan, and the government is going to want that money back.
Yeah, Slocomb, I might be able to weigh in because I've executed on both forbearance and PPP, and so like I have the real world experience in this, and my experience from my lenders on the forbearance is what you had outlined. Like those two options were presented to me when I was asked. It was either for me in my apartment buildings, it was 90 days forbearance or 3 payments tacked onto the end of the mortgage with a balloon. And for me, those forbearances were great. Freddie Mac's forbearance was presented to me as 90 days, and then it's due at the end of 12 months. And for me, I didn't want the red tape to do that forbearance. So I executed on the first option and passed on the second. We went through with the PPP loan, processed it. It's already funded. Kurt was pretty spot on. We have a management arm of our company. We have 12 employees, And so they took the trailing 4 quarters, and it was like 2.5 months, or the trailing 4 quarters, averaged it monthly, times it by 2.5, and that was our loan. We'll have no problem deploying almost all of that to payroll because our company's been growing. So the calculation was off of trailing. Moving forward, we'll be able to pretty much use all of it for payroll and get it forgiven. The 1099 question that you had, Slocomb, we pay lots and lots of money to 1099s as well. And the answer we got on that was no, because actually the PPP loan was available for those 1099 subcontractors themselves. And so they don't want double dipping to happen. That was my understanding. Obviously, this is just in my own personal experience. I'm not doing these loans for other people, but that has been my experience with forbearance and PPP.
So let's talk about this a little bit further. Let's imagine a hypothetical real estate investor who happens to have about 1/10 the portfolio of SNS Capital, and also a really sweet black and yellow headset with lights on the sides, who is considering forbearance, but is thinking to himself that there may be some advantage to not taking forbearance now and not using SBA loans, so that after the dust clears and we're looking at investing over the next several years, he can go to investors and say, look, when the storm got rocky, I kept my ship steady without needing forbearance, without needing these loans. That makes me a better borrower, hypothetically speaking. And again, this is an investment portfolio that is exponentially smaller than Jered's, and so it faces different challenges. But is there any merit to that? Being able to say in 2021, 2022, look at me, I didn't take forbearance. That makes me a better borrower?
I think Kirk can answer it better, but I have some real world examples of how I went through that same thought process.
Great.
After Kirk goes.
You know, one thing I do want to clarify for what we were saying before is, like, when we talk about Freddie Mac and Fannie Mae, the residential and the commercial side are two different ball games. And I think, Jered, you know that you can get a government-backed loan through one of those on your home with a 30-year fixed rate. But the Freddie Mac, Fannie Mae, small balance, mid-sized loans, they're a different ball game when you're talking about multifamily apartments. So breaking this kind of down in two different ways, on the residential side, you know, for the smaller investors, is it going to impact your credit report? No, it's not going to get reported against you during your pause period, if you will. So, you know, that it's not going to report lates or anything like that. That's my understanding. They're going to give you a lag time on that. So personally, will it hurt you? No, but coming from an investor side, if you're going to syndicate loans and pool money, I guess it's all about your track record, you know, what you're pitching, who you're pitching to, kind of trailing in good and bad economies. But from a banking standpoint, you know, if you did one, a lot of like if you have a small portfolio for your hypothetical borrower, Slocomb, you know,
who happens to have a sweet beard, for the record. Sorry, go ahead.
I'm just looking at a guy with yellow headphones. So I would say that, you know, a lot of times smaller investors will have portfolio loans on the commercial side. A portfolio loan being a loan that a local lender, maybe a credit union, mid-size regional bank, a savings and loan will hold on their books. They're not selling it as a mortgage-backed security. And that's where you get more into the Freddie and Fannie. That's securitized, that's sold off. But with these smaller loans, you're looking more at some type of modification agreement. They're not necessarily I mean, you can go into forbearance. When you go into that, you're trailing more in towards like default. But you're looking more of a modification on the commercial side. With a modification, they can do a lot of things where they can go interest only. They can set aside no payments for 6 months, escrow for future, things like that. That, becomes an investor choice. That's probably where I'm going to leave it for Jered to pick up at. Maybe you have more insight on that end of the investing side of it.
Yeah. So, I mean, I had never even explored I didn't even know the word forbearance until all of this came about. And so as this was developing, I expressed that ignorance to my lenders and was very honest in where I stood with it. I said, I have thousands of people who live in our properties. They're obviously losing their jobs. I don't know how this is going to go, but I would like to be proactive. And if there is an option to shore up my cash flow, I would like to take advantage of it. But I'm also in very much growth mode for our company. So I'm not going to do something that's going to damage us long run just to be proactive. All of our lenders said, no, we're not reporting this to the credit bureau. We understand what you're doing. And so never did I try to mislead one of our lenders and say, like, I'm in trouble, please help me out. I just said, I don't know how this is going to go, but I would like to get ahead of it rather than wait. And I will use this money wisely that you guys are pausing or forbearing or modifying the loans. I'm going to use it wisely to make sure that my operations make it through this pandemic. And all of them were very understanding. And so they would lay out the options that they had on the table. I would choose if I wanted to go forward with it or not. And we kind of talked about it. I did with a lot of our portfolio lenders. I didn't with Freddie Mac loans. And all of them have said there is not a long-term negative impact. And what gives me even more, I'm always a little skeptical. It's like, are you sure? Because, if I do this, is it really like, a year from now when I come and try to get a loan, are you gonna be like, yeah, but remember that? But to give everyone, including myself, reassurances, I took forbearance from portfolio lenders. And then even since I did that, I went to them for a cash out refinance on a deal, and they're more than willing to do that loan. Freddie Mac extended me the offer for the forbearance. I actually turned it down, and they're also doing a cash out refinance for me right now. So it's kind of like they see it as this is an option on the table, and taking it is not necessarily saying I'm in big trouble. It's just like, here's a tool. If you can use it wisely, let's figure out how to do that together. So that way you can work on your operations to make it through this, and we as a lender can be more confident that you'll be out on the other side and not default. So that's been my experience in the fact that they've been willing to lend after I took forbearance, even though this is a very short period of time. We have a lot of different things going on. So I've been able to see them not even bring it up, in the loans that we have in process, and we're in the middle of forbearance. We're not paying them for loans we have, and they're coming to give us more loans. So seems to not have a negative impact.
Jered, that's very exciting to hear. I may need to talk to my commercial mortgage broker about a couple of my deals here soon. Todd Calsey, who is listening and watching in, has a very good question for Jered. What were your non-payment numbers like for April? Where did you how much of the fear-mongering about getting April rents paid that we heard back in March, how much of that did you experience?
So, I was uncertain as well. And so that's why these conversations with the banks happened. But I'll give you the number, but I'll preface it with, we asked our leasing staff to do a lot this month to reduce the delinquency number. We essentially asked them to not only be leasing agents, but to be social workers. And so what we did was every single person was getting called frequently. Every single resident was getting called, emailed, and we we were essentially guiding them to get third-party aid, how to file unemployment, all of these different avenues to prop them up. And right now, I'm really pleased to say that our collections for the entire portfolio is at 96%, and that's dollars. If you look at number of residents, it's 97% because we had a couple of them that had balances that rolled over from even March. So when the eviction courts closed, we couldn't do anything, so it rolled from March to April. And so that's included in our outstanding balances right now. So even including those, we're at 96% collected. And I ran a number today that I thought was just, it says a lot, but of the delinquent accounts that we do have, 60% of them are from inherited tenants. Only 40% of them are from tenants that we placed. And so even though our numbers are strong, there's another number inside of that showing that our screening is working and how we're selecting tenants is protecting us. And so that's where our numbers are for April. Hoping to continue that for May.
So it's great to hear that you guys are very proactive in engaging your tenants, Jered, with making sure that they were going to be okay, making sure that they had access to the resources that are available. What did you put any systems in place for what your leasing team should do if a tenant said, I'm not going to make it this month. I'm not going to be able to pay April rent.
Mm-hmm. Yeah, so we did lay that out for them. We had, and it's been developing, but at the beginning of the month, what we did was we had 4 options. Option 1 was pay rent as normal. And these options are essentially for the resident. So think of it that way. Option 1 is you pay your rent as normal. Option 2 is you pay your rent however you can with third-party aid. And here's some resources, and we're going to help with that. And then option 3 was you can pay your rent using a security deposit hardship draw, meaning like a lot of our tenants have 1 month's rent security deposit. And so if the rent's $800 and their security deposit is $800 and they say they can pay $500, we'll draw $300 from the security deposit to pay full balance.
Before you give us number 4,
yeah.
With that, you called it a security deposit hardship draw. Let's say the deposit is $800, the rent is $800. They say they can come up with half. You allow them to take half from the security deposit. Are you doing anything to make sure that $400 taken from the deposit gets back in there from the tenant before the lease is up?
Yes. So they sign an addendum when they do that, and they add $25 a month payment to their rent until that full amount is recouped. Until we hit 12 months, then it all would be due. So 25 times 12, if they took more than that, then it would all be due in 12. Now, let me stop and not go too far because we did put a lot of thought into that. And what really surprised me was no one used it. I still don't understand it, but people don't really want, they're thinking of it as debt or something. I'm not sure. We had no one use that. So the 96% collection rate that we're at is all through option 1 and 2. We did not have a single resident use that. But what's good is we have that now for May. So we have an asset to tap that we can use these security deposits to potentially, it's a kick the can down the road solution, but potentially to bridge the gap until people are working again or their unemployment starts to come in or whatever. We really liked the idea, but it wasn't adopted by the residents in the way that we thought it was going to be. And I still haven't figured out exactly why, because if I was in their shoes, I'd be all over it.
You said there was a 4th option for your tenants.
Yeah, so the 4th was, and these were supposed to be released on certain days. So for option 1 and 2, that was just straight from the get-go. The leasing staff was able to present that. Option 3 was released on April 15th. And then option 4 was supposed to be released on April 25th, which we just put a pause on it because no one took option 3. But option 4 was supposed to be after you've used the full security deposit. If it was not 1 month's full rent, we would go into a payment plan. That payment plan would be whatever the balance was, you divide it by 4, and then they would have to pay that over the next 4 months. We haven't used that either because you had to exhaust options 1, 2, then 3, then you could use 4. And so we laid all of this out to try to be ready, and we ended up not needing it. But it is still on the table then for May as we see how that develops.
So, interesting point of comparison, Jered. When for those of you who haven't figured it out yet, the hypothetical investor is me, and I'm going to stop using that third-party nonsense, that third-person nonsense. So what we did, Jered, because I am our leasing department, and I am also a full-time real estate agent, and so I wish I had the time to be making all of those calls and to be as personal as your team was. And I have dreams of getting my portfolio to the point that it is the size that I can have that staff. What I did was I reached out and I made sure each of my tenants heard from me the evening that shelter in place was announced by the governor, to let them know that we would have an option available. That option effectively became, the metrics are specific to non-inherited tenants. So these have already been through our screening. And I'll tell you, my experience is very similar to Jered's, that the tenants that we have pre-screened and approved and placed ourselves, to use dry financial terms, are performing better right now. The option that we gave was that for 1 or 2 months, all of this will be in writing, we'll cut your rent in half. So we'll go from $650 a month to $325 a month. After the 1 or 2 months, we will sign a new year lease. The lease is signed in advance, but it starts effective after those 1 or 2 months at a 5 or 10% rent increase. So for a 50% reduction in rent for 1 month, 5% increase over 12 months means that they'll be paying 60% back, which means over the course of 13 months, they will have paid $65 more than they did if they didn't take the plan. For $650 a month for a 1-bedroom, that looks like $325 a month for 1 month, and then $682.50 for 12 months after that, or $325 for 2 months, and then $715 a month for 12 months after that. And I have had a few tenants take me up on that. What do you guys, stealing the spotlight for a moment, what do you guys think about a system like that?
I think as soon as you present it, they would bite on it. But, what we were trying to do is disincentivize collections falling. So, I mean, we didn't present the option until the 15th, and then it seemed like we had done so much outreach prior to that it was already in the tenant's head of like, I'm going to make my payment by the 30th. And even our 4% delinquent rate, a lot of those are committed to paying by the end of the month, which is, quickly approaching. But as stimulus checks come in, things like that, I think your example, I would be hesitant to do that because I would fear it would be abused.
Sure. So I did not put the details in the first message I sent to tenants. I wanted them to have to come to me and ask for those details. And I'll tell you, of the tenants who have reached out to me, it's about 50-50. How many have taken me up on that and how many haven't? Mm-hmm. Another possible bonus, or another reason why we structured it the way that we did, is that the property at which we expected the most tenants to take that deal, keeping in mind we're signing new year leases at a higher number, we are preparing for a cash out refinance around the end of this year. And we will have tenants paying higher rents on year-long leases at those rents when we go to that refinance. And so we're hoping that that can help us with the valuation that we receive, because our average rent will be a couple percent higher.
Mm-hmm.
Back to Kurt for a moment. I'd like to get your read on what's happening in the residential mortgage market, the loans you typically see for a single family home for someone who's going to live in it, or a 1 to 4 unit rental property. I am hearing people say rates are low, do it now. I'm hearing people say we are not borrowing, or we are not lending. And I'm hearing people say, yeah, we're lending, rates are high, fees are high, your credit score has to be high. What does that landscape look like, Kurt?
All the above. And really it just comes down to the lender. And I think I could say this about residential and commercial. Banks, everybody's kind of waiting for the other shoe to drop. When's it going to happen? Everything is a timing question, and no one really knows. Obviously, we have our, ease back in plan where things are starting to open up little by little, but we're not going to really know how that totally affected the economy until later down the road. So right now, the residential side, banks that kind of have their fill or that are skittish just raise their rates. They raise their costs, and it's kind of a way for them to say, we're good. We're willing to take the chance right now if you're willing to pay a higher rate. They get more spread. The ones that are still, really low, a really good 30-year fixed mortgage for top-tier credit and everything today is anywhere between 3.25% and 3.5% for a 30-year fixed on a home, on your personal residence. So that's, is it still some of the lowest rates historically? Absolutely. Does it make sense to refi? Yeah, it can. But, it's still in that range of nobody knows. The issue that you run into is on these federally backed loans, it was put in that, every appraisal has to be a drive-by appraisal. So is there some issues with value? There can be. It just is 100% put on comps. They can't see what you did inside. Maybe if you renovated it or something. I've had some come back where we have to go and send back the original plans, specs, the draw request, everything to show that and comp it out to the correct comps. So it's been difficult to navigate. But yes, are there lenders out there with the lowest rates and terms willing to refinance you right now? Yes. Are there lenders that are holding off on the sidelines? A lot of those are the smaller ones that can't afford mistakes because it could take them down in the long run. And then there's some who are so backlogged thanks to pooling underwriters and all these staff every which way to do PPP loans, because once you get your authorization, they have to fund within 10 days. So that's crunch time. And the banks are making money on that too, by the way, which is a whole different story. But that kind of took priority, whereas these residential loans and commercial loans, underwriting, kind of getting through the process to your clear to close has taken a back burner. So the ones that are hiring off higher rates are kind of saying, we got enough to do right now. If you're willing to take this higher rate, sure, we'll do it.
So if I go back to the lender I have used in the past, because I'm thinking about a refinance for whatever reason, and I get an unsavory response from my lender about my refinance potential or what the loan will look like, do I just need to find a different lender who has better options?
It depends on what you're going for. In terms of if you want to cash out and refi right now and pull money out with some type of added value to it, if your current lender is saying no, look for someone else. There are still some lenders out there that are aggressively looking to build their portfolio. If you're looking just for a rate and term, I wouldn't necessarily let them talk you into just doing a full blown refi. If you're not changing the balance, they should be able to do a modification at a lower fee. A lot of that has happened in April to help offset, re-amortize the loan based off a lower rate or an extended term or something of the nature where, extend the AM back out to offset your payment and lower it. So it depends on the scenario. I hate to be broad like that, but if your lender's not willing to work with you, yeah, I would look. There are options out there right now. They're not as many as there usually are. You're finding more of a needle in a haystack. But yes, there are some that are still willing to, like Jered said, they might modify you on one, forbear you on another, and then do a brand new loan with you on the third. The best way to sum it up, especially on the commercial side, is lenders care about the relationships that they have, and they're willing to work with those clients. But right now, they're very focused on taking care of the current clients they have. So if your lender's not willing to work with you, yeah, look elsewhere, because there's going to be a lender looking for a relationship, and probably a full-blown relationship.
Let's talk a little more about what commercial mortgage lending looks like right now. I have heard everything from rates are the lowest they've been to it is impossible to get a commercial loan. If you're going to buy something with 5 or more units, you have to pay cash. What's the deal there? And what's the deal there?
In a nutshell, banks are more selective than they've ever been. And if I called all 30 of my banks today locally, I think about 25, maybe 26 of them would say, or I should say actually have said to me, we're willing to look at any deal, but every deal we look at is on a case-by-case basis. They're not opening the floodgates and saying, hey, for every 12 unit and under you have, we're going to do 80% LTV and 10-year fixed. There's no set program out there anymore. Everything is a case-by-case basis. That case-by-case basis kind of leads to the stronger the deal overall, the more likelihood the bank is going to be okay with it. If you're out there right now looking for a 5-unit or 6-unit and saying, I only want to put 10% down, I want the seller to carry 10, I need a 30-year AM to cash flow this, yeah, pay cash. Those type of deals are harder to get done right now. Most banks are pulling back on LTVs. Most banks are wanting to see more liquidity post down payment. Banks are wanting to see, whereas they might have had a minimum debt service coverage of the subject property at like a 1.2 or 1.25, are raising that. And then, any type of secondary source of income. There's your primary source of income, which is the cash flow from the property. Secondary being the global cash flow. So if you have a secondary source of income as the owner, that's becoming more prevalent again on a global perspective. And then your tertiary source of repayment is, the property itself, liquidation of the property. They're putting in a lot more things in place, whereas, hey, if we were to take this back, much as an investor would look at a cap rate, a bank would look at the loan amount and say, okay, if your loan's 400 and you're netting 40,000 a year, yeah, you kind of look at that as a cap rate. They look at that more as a take back rate. Is it enough to hire a receiver and us not lose our butts? So they're adding more tests into things, which is making it harder to lend. And that's why they call it a case by case basis. But if you're looking for the stuff that we were seeing in 18 and 19, where you could get away with a lot less down or something, those programs, if anything, are on hold right now.
Gotcha. Question from, go ahead, Jered.
I'm going to just add to it. And Kurt said it's on a case by case basis, but I agree with that. But I'll also add that in my years of borrowing, I've learned that in the commercial lending space, and you specifically outlined Slocomb, like anything 5 units or above, everything's case by case basis. Like in the good times, the bad times,
Yes.
every lender has levers they can pull, and you just have to understand what their incentives are. And like, Kurt mentioned, what's their take back rate, what's their debt yield, what's their debt service coverage ratio, know all these things. So then you can say, well, if we adjust this leverage, I want that and this and this. And everything's always been case by case when I've talked to even the agencies where they said like that, you have to fit the square peg into the square hole. No, there's always a little bit of movement, and you can ask for this or that or the other or whatever fits, and never hurts to ask. So like, not just pandemic time, but all times in borrowing, like everything's case by case, and you can always ask. So people who are listening and watching, keep that in mind as you are borrowing.
Jered has told some very good, very helpful for me stories about his experiences in commercial lending on the Bigger Pockets podcast. Any chance, Jered, you remember which episode number that would be if people wanted to go find it?
I was on twice. I don't know.
I want to say it was the story that I'm remembering is when you opened a line of credit and then drew on it so that the bank could have more cash on deposit so they could offer you a bigger loan.
The number maybe 223, but I'm guessing.
Okay. Well, Jered has some really good stories to tell about creative ways that he's been able to work through commercial financing. He told some of those stories on the Bigger Pockets podcast already. You can find him there. Quick question for Kurt, and then we'll move forward. This is from our audience on loan modification. Instead of just refinancing, modifying the loan I currently have with the current lender, are you typically seeing local, regional, or national lenders being more willing to do a loan mod?
I know a guy with a yellow pair of headphones that can probably agree with me that on the national level, they don't care. They don't care. You're a drop in the bucket. And they say the same thing to me with the fourplex. They'd say, go refi. I would say you're looking at a smaller regional bank, credit union, savings and loan, any type of those smaller lenders where you have that relationship. They're in there, that's their footprint. You're actually a client. You have a depository account. You're kind of all the above. They're more willing to work with you. They're more willing to modify your loan. They don't care if you pay off. Not to throw banks under the bus, but the Fifth Thirds of the world, they're not looking for the $500,000, $600,000, apartment loans anymore. They're looking they want 25 million above. They want to be a mid-size, lender. They want to be middle markets. And the bigger the loan, the less staff you have. The less staff you have, the less overhead you have, the more profitability you have. With that being said, they don't care about roll-off. These smaller regional banks type lenders, they care about roll-off. They care about doing more deals with you, helping you grow. So that's probably where you're going to find it more apt to get a modification for them to work with you on that front. Or even if it does come to a refi, they can refi you in-house and use a lot of the same third-party work or something and lower fees to make it more appetizing to do so and not more cost-effective.
Yeah, I'll add to that is the bigger they get, the harder the conversation becomes. And one of the easiest ones for us, and it becomes more of a relationship. So at one of these banks that we've used to buy single families, duplexes, quads, small apartment buildings, even some mid-size, it's a local bank that we've used for years. And we actually, I learned that we are the highest borrower at that bank. We hit their legal lending limit, and that gives us a lot of control. They cannot let us default. They want to support us, and because of that, they give us a lot of flexibility and wiggle room. And when we ask for something, they are more likely to give it because if you are the highest borrower, they cannot see those loans go bad. And so there's an advantage to maxing out a bank as well. I've learned this.
Yeah.
Not a phrase I thought I'd ever hear. There are advantages to maxing out a bank. Sorry, Kurt, go ahead.
Now, Jered's right. Typically rule of thumb is on it's you can lend up to one individual or one company, typically up to 10% of your asset size. If your asset size is $1 billion, if you're lending them, say 100 million, they cannot afford for you to fall. Because when you truly look at the asset size, it's comprised of more just than cash liquidity on the balance sheet, and they don't want you to go in forbearance. They don't want you to go through foreclosure because they're sitting on that stuff for a year or whatever. You can take a bank like that down. That Jered, don't.
It's more about the relationship.
But I get you. But it is.
I am getting flashbacks of like Tywin Lannister and the Iron Bank and Thrones, and Cersei Lannister pays off the debts and then she loses the war. Sorry for the dirty Game of Thrones references, but and I'm not saying anything about Jered's moral scruples if you're not a fan of House Lannister. I'm just saying that Tywin Lannister had a very clever way to use his lenders. Yeah. Sorry, please continue.
I mean, there's a saying, I don't know the exact numbers, but it's something like if you owe the bank $100,000, they own you. If you owe them $100 million, you own them. I've heard that before. It's like, they cannot see you fail because you would pull the bank down with them. And so incentives align a lot more. And as you go into Fifth Third, that number has to get ridiculously high to even have them even think about it. So I've experienced it firsthand.
Gotcha. Let's shift this conversation. I want to make sure we have the opportunity to take more questions when we're done. But let's look towards the future now. I'd like to hear from both of you with regards to your tenant's ability to pay May rent and in months moving forward. Do you expect there to be more hardship than there was in April? Do you expect there to be less? And why?
I'll jump in first. I would expect more, but I am not someone who would say I'm for sure of that. Like, I guess we'll see. There's so many components and moving parts. The stimulus, unemployment. Is unemployment being paid? Right now I think they're at a little over 50% being paid, and at least the state of Ohio. And so all of these things combined will determine if our payments come in. But I will say that our April payments were good, and we saw that mostly propped up through like charitable third parties, Salvation Army, things like that. And so our residents weren't seeing the stimulus check, the unemployment, these other things that I think will kick in May. So I'm hoping the charitable third parties propped up April, and then the government-backed prop will happen in May, and then we'll have to take on June when June comes.
Yeah, hopefully there aren't a bunch of large television boxes in your dumpsters right now.
Yeah, there are.
Kurt, did you want to jump in on that?
I agree. I think everything's kind of a lag time. A lot of people, to pay April's rent, we're still getting a check coming in at the end of March. A lot of times, you're on your 2-week pay cycle. Is how majority of them do that. And you're still having the cash to be able to pay that month's rent, or have like Jered said, a lot of things, a lot of different programs to be able to help you. And now the stimulus check has come in, you would think that would pay May's rent, but the question comes down is, or I guess you put it best, we'll deal with June when June comes.
Mm-hmm.
Where do you think the market is headed with regards to with regards to property values And let's just stick with that. Do you think, do either of you see property values going anywhere here soon?
Jered, do you have a?
Yeah, I mean, so I'm looking at larger apartment communities right now, and in that underwriting, you have to underwrite the unknown. So there's uncertainty. I cannot underwrite the same as I was 2 months ago, because I don't know what June will look like, and I even don't know what May will look like. And so investing is all about risk-adjusted returns, and so you have to make that assessment of the risk of the unknown for you personally and your company, and then adjust your underwriting accordingly. So I think everybody's will be a little bit different, but I think my guess is in the apartment space is we'll see people just kind of pull back and pause and wait. And those who are forced to transact, like say they're having a loan come due or something like that, will see a price drop. But how much, I don't know. I couldn't say.
I would say I mean, I agree that, if you're forced to transact, refinances might be a little hard because I feel like there's going to be less market data for an appraisal. Cap rates might be rising a little bit for transactions that do happen because sales might be a little more forced. I think in the future, 2021 is going to be a big year of showing a lot of different things. We wrote out a really good year of 19. 2020 started off good, but with, printing this money to stimulus checks and PPP, it all has to come somewhere. We have an election coming up, not to get political, but it's kind of in everyone's best interest to kind of keep everything afloat and look good right now. But what the aftermath of that leaves, who knows? You're going to see rates go up. And I think that's a direct correlation to values of real estate, specifically apartments, because you're essentially getting the spread, from your cap rate to the rate. I mean, you're kind of getting the spread as an investor. And it's risk-based. Like Jered said, it's risk-based. So your underwriting adjusts. Freddie and Fannie, for example, on the big multifamily deals, right now, they're requiring more reserves of 12 months of P&I, taxes and insurance escrows, all up front. It's making harder for investors to come in, especially on purchases. So with less transactions and less data, I feel like appraisals, especially on refis, might come in a little lower. So I think you could see some values dip a little bit.
With values dipping and with what we assume is a lot of owner-operating landlords and other landlords experiencing some distress with this market shift, and with so many of their tenants getting laid off, do you think we'll see, as an investor who's interested in buying, do you think we're going to see more opportunities, more better deals than we've been seeing in this really constrained sellers market, even in the multifamily and the apartment space? It's been tough to find good deals. Do you think it's going to get easier anytime soon?
What size are you talking about?
So, well, let me give a potential answer to the question, and then you can play off of that. What I'm thinking is that there will be landlords likely who are not using professional property management, who are doing it themselves, or who are using so-called professional property management who isn't doing a good job, that is not as proactive as Jered in reaching out to their tenants, who are going to feel much more of the financial hardship coming from this current health crisis and economic climate, who are going to decide that now is the time that they need to get out of real estate investing, or that they have properties that they just weren't able to get performing the way that they wanted to, and now it's time to sell. I would suspect that you'll see that everywhere from single family up to potentially 20, 30 units. I don't know when you get above especially 50 units, if that will be as applicable. But do you guys, I mean, the question that a lot of us were asking a month ago, and the question that we asked in this meetup the last Tuesday of March was, is there going to be a fire sale? When will it be? And will I be able to get a loan to buy all the things that are deeply discounted? I don't think that's the question that we're asking necessarily, but do you think that there are going to be better deals available than we've been seeing for a while because there are people who want to sell now based on what they've experienced in the first and second quarter of 2020?
If I had to guess, I'd say yes, but you also have this weird asterisk of like, you fire sales are usually prompted by this motivation or a cash pinch, but then you also have this weird time where you can essentially just walk to your bank and say like, give me a couple months off, and then they're like, sure. So, you know, we might get delayed on that fire sale because people are saying, can I have 3 months, no payments? And they're like, yeah, 3 months, no payments, no problem. And so those motivations to sell might get kicked down the road. So you might not see it in May or June, but you might see it in July. I think in the larger space, like you said, 50 and above, you're seeing we've had 10 years of good times, and a lot of people were smart enough to put cash reserves away. And I think we'll be able to bridge, most of the owners will be able to make it through, and they're not going to be overly motivated to sell in a time of uncertainty. But the people who like are self-managing incorrectly and stuff, potentially they'll just get burnt out from the ever-changing like juggle of laws that they have to follow. And they're just like, I'm tired of it. I can't handle the ever-changing government enforcement of different laws. And so I just want to be done, and they'll make exits. So I think we'll see more sales at a better rate. I don't think it's going to be like crazy all at once. I don't think even in 2008 and 9, it felt like it was all at once, but that took months and months and months to uncover. So I would say yes, but not to the extent of 2009 or 10 is my guess, and it is a guess.
Yeah, I would say my best guess would be kind of mirroring that. The bigger ones, the 100, 150, 200 unit, the owner operators, most of them have been in the game. Most of them understand the last real estate times of 08, 09, 10, when things went down. A lot of them are smarter. They're sophisticated enough to understand that liquidity reserves is a very large thing. A lot of them locked into low rates for really long terms. So there's no motivation for them to sell. As long as they're a good owner operator, there's no motivation to sit back and cash flow. For the smaller guys, especially, you know, specifically the ones that come to mind, and I don't know why I harp on this, but it's like the 24 unit ones where people are paying $1 million, $1.2 million, $1.5 million. I've even seen a 12 unit go for $100,000 a door, and I would call it Class B. You know, when you get in that range where people come that are not as savvy in the area, or it might be their first one, or that might be their side project, and you're really levering out, and it was a time when a bank would give you 80% LTV. You know, I could see some hardship coming in the future, but like Jered said, is it going to be right away? No, because you'll get a bridge. You'll get a bridge from, not a bridge loan, but you'll get, you know, like some type of deferment for 3 to 6 months. So, you know, by the time they get into some type of short sale or start missing payments or realizing that it's not going to work for them and they have to take a dive, I don't think you'll see stuff until end of the year, beginning of the year next year. But then again, like, that's a guess. That's my guess. If rates go up and some of these levered up people have to refi or coming on, you know, 3-year balloons or 5-year balloons, they might have to sell.
So investors we are constantly thinking about the future and where things are headed. We also have lots of very clever ways to get out of sharing our own personal projections. So I would like to honor that and not ask you for specifics. However, I will ask, and I will answer myself, what are you doing anything right now to prepare yourself as an investor for the potential that there will be more good deals that you want to buy than you have seen in the last several years? Is there anything that you're doing as an investor to be ready for those deals to come?
So I am, and I think you asked that really well, because like I absolutely am always thinking about the future and trying to plan and trying to be the most prepared. But I also am not someone who considers myself like, I'm not a genius that knows, so I don't want to mislead someone. Like, it's their responsibility to make those same, guesses and then adjust their strategy accordingly. So we're doing several cash out refinances that we started. Essentially, we're trying to strip equity from our portfolio and get cash heavy. And then also, we have been selling off all of our small assets prior to the pandemic and everything for the same reason, to increase liquidity so that when there is buying opportunities, we can execute on them. When that will be, who knows? I just like to be prepared. So the cash out refinances are going great for us. The appraisals are still coming in very strong. The sales of our small assets are going really great. Even today, we listed one. Multiple offers came in. One of them came in at 115% of asking price. So like, what I'm seeing is our efforts to be prepared to buy are working, and we will be prepared to buy. But when that will happen, I don't know. Could take months, could take years. But as investors, you have to be prepared to execute on good opportunities whenever they do come. And so that's how we're doing that.
I was going to give a less eloquent, less informative version of the same answer. So just chalk me up with Jered on the plans. Go ahead, Kurt.
I was just going to say, from a very small investor, not of Jered's size, but probably for the smaller investors looking to where you can double your portfolio overnight. If you're looking, 10, 12 units, looking to get 10, 12 more over the next 12 to 24 months. Something I did to double my size when I did it was, first of all, do what Jered did. You're stripping equity out of properties that you have, that you've managed well, that cash flow well. I say this as an investor, but also leading into underwriting from a bank. Don't lever yourself up to 80% LTV on everything you got, where it barely cash flows, and look bad globally. So what I did was I levered up, but if you hit the timing with really low rates with long terms, you're going to look better on paper to banks too. So if you can show them that, hey, I've owned a 12 unit, I've owned a 24 unit, I cash flow really well at this debt service level, I've done it for 3 years, I self-managed it, your resume is on paper in terms of numbers, because that's what they're looking at. If you can make the numbers work, they'll believe in you. So that's kind of what I did. I refied a big part of my portfolio in 2019, locked into a 10-year fixed rate, pulled some cash out for reserves for future buying, but then I also pulled some cash out to do some big CapEx stuff. So, I wouldn't take big expenses over the next couple of years if bad times were to come. Then I'm looking good on paper from a cash flow standpoint in the future when banks look at me when I need to apply for a loan, and I have the liquidity needed to put down to deploy on properties. So kind of twofold, if you will, or I guess maybe elaborating a little bit more on what Jered said, but mirroring that.
Yeah, I mean, Kurt, you bring up a good point of saying, like, I started this in 2019. That brings up a great point, is you shouldn't be preparing to be buying during a downturn. In the downturn, you should have prepared well in advance. And so that, I answered in a way that I think, Slocomb, you were thinking, and kind of, what are you doing right now? But we've been doing things for 10 years, honing our operations, figuring out how to, keep our expenses as thin as possible, figuring out how to communicate with residents, all of the internal aspects of how you operate a business. And I mean, you mentioned it, the people who are owner operators that might not know what they're doing are the ones that are going to get stuck in a pinch. So how do you prepare for a downturn is you get really good at operating. So that way, as you go through a downturn, you're not the one in a pinch. So, helping your cash reserves as the times are good, honing your operations, all of these things are important, not in a downturn, but for the decade before it.
Kurt, quick question, and then I want to make sure we can take questions from our attendees. Do you foresee any issues as deals potentially get better and become more available? Do you see any issues coming down the pike with residential and commercial lending and the availability of loans?
It's yes and no. If there's this blanket statement that, oh, I'm getting this sold for $1 million 2 years ago, if we're in 2022, and I'm getting it for $600,000, I'm getting a deal. I don't understand why a bank wouldn't give me a loan. Well, there could be multiple reasons. With those deals presenting itself, how bad was the owner operator? What did they do? How much deferred maintenance is there? But also mainly looking from a banking standpoint, you have to understand that when we've rode such a good economy for so long, and say in the Cincinnati MSA, the standard vacancy rate's 4%. I mean, I'm sure it's lower than that, but banks use a standard 5% vacancy rate, and that is like a standard on every deal they do. No matter what pro forma you give them, they're still putting in certain CapEx reserves, vacancy rate, management fee, and they're adjusting it to their underwriting. They're not just going to take your word for it. And even if yours is lower and you got a signed contract with the management company, they don't care. That's their underwriting policy. That's their standard. So when those times come and the standard vacancy rate becomes 10%, which we used to underwrite, 11, 12, and 13, and even a little bit into 14, we were underwriting a vacancy rate of 10%. That's a big difference on cash flow right off the top. So are there going to be some of those challenges when you're getting a good deal? Sure. But, it kind of mirrors what Jered said with you prepare even in a good economy for a deal in a bad economy, and you're going to learn that with experience the same way that you're going to change your underwriting. And he said that, you're going to change your underwriting, you're going to get better at operating expenses. But the one thing that you're going to have to do when you start looking into, these discount deals, if you will, you're going to get bigger discounts on underwriting. And then the other piece is where you're achieving $750 a month on a B- on a 1 bed, 1 bath, is that still achievable at that time that you're picking it up? Being able to achieve the rents at a higher rate, because we've had a really good rental growth rate in Cincinnati, a really good one over the past couple of years. If it's not going to keep growing but trail off or just even stay stagnant, it's all dependent on the underwriting, I would say.
It sounds like you're saying that when I'm worried about my borrowability or the borrowability of a deal, if the market really does continue or take a downward angle, focus on what rents I should be able to accomplish and what my prospective vacancy rates will be.
If that's what's happening with the property and someone, you're looking at trends. Just because you're going to buy it doesn't mean that they're going to give you the 2019 trends of a 5% vacancy and the highest rental rate in the market. Sure, you can rehab it, you can put money into it. I understand that. But you kind of have to look at the market at the time, the same way any investor does their underwriting. What rents can I achieve? Look at the current market, vacancy rate, current market, what type of reserve rate or management fee. Just you kind of got to play with the numbers with experience and knowing what's going on in the market in that time.
Slocomb, you mentioned like in one of my previous interviews, like one thing I think that I'm good at is understanding the incentives of lenders. And you have to understand that in this time, the same exact uncertainty that you feel as an investor, the banks also feel that same uncertainty. And so they're going to adjust just as you're going to adjust. And you just have to come to a common ground where you both are comfortable with that uncertainty. And it's probably going to be lower. So loans are going to be harder to get. Like that, I think that was your original question. Like, is it going to be harder? Yeah, because it's uncertain. And they feel that same uncertainty.
To sum it up, it's going to be a case-by-case basis.
Yeah.
Very helpful answer, Kurt. Thank you. So I want to take a moment to give our attendees the opportunity to type questions they have into the chat. While they're doing that, I'll share a statistic with you that Tyler Dietz, a friend of mine and a realtor with the Chabris Group of Keller Williams in Cincinnati, shared with me, or shared in the chat earlier. The Cincinnati Multiple Listing Service from March 1st to March 24th saw 1,272 closed sales in the Cincinnati area. And the 24 days following that, beginning March 25th, there were 1,215 sales, which is just over 95.5% the activity that was happening just before the shelter-in-place order came in. That being said, these numbers reflect sales activity that began 30, 60, 90 days before shelter-in-place started, and so we are not likely to see the full impact in the market of what's going on right now for the next few months, the way that we've been discussing. Question from our audience. Jered, can you speak about your transition from smaller investor to larger apartment complexes? What was your inflection point or the catalyst to make this transition?
Those are fancy words. No, I guess the one that comes to mind is when we purchased a 42 unit. And so I think prior to that, the biggest we had was a 5. And so I would call that an inflection point, and where I was really looking to make the jump. And it came down to operations again. Like, I consider myself a professional operator. And at that time, we might've been at 50-ish smaller units, smaller properties that combined to 50 units total. And it was getting really difficult to operate. Staffing didn't make sense because it wasn't big enough for that. But so we needed to jump, and we needed to make a big jump quick. And so I didn't have time to buy 42 single family houses. I had to do something quickly. And then also, I've always really liked the control of the value that larger properties give me. So like, I'm good at operating, and good operators get to force appreciation. And so operations is what made the catalyst happen of making that jump. You know, operating because I had to, because I couldn't sustain operations without having more units. And then also because I liked operating to control the value. I can operate a single family house really, really well, and it just doesn't matter as far as value. But I can operate that 42 unit extremely well and produce huge cash out refinances that allow us to continue to grow our company.
I had a similar experience on a smaller scale. I was standing, well, not really standing. I was in the basement of an old 3-plex in Mount Auburn, so I was kind of scrunching in the basement with a structural engineer who I had just paid $950 to look to do an inspection for me of that 3 unit, when a partner and I decided that we were going to go after a 24 unit, and we didn't need that 3 unit anymore. So $950 down the drain, but a very good, that was my point of inflection, Todd, to answer your question. That $1,000 I wasted on a building I decided I didn't want to buy while I was doing my due diligence. But a similar revelation that I was getting to and am now in that point where my portfolio is a little untenable in size. I've heard it said, and you all may have heard me say this too, that the worst business in the world is owning 2 McDonald's, because you can't afford to hire a general manager until you own 3 McDonald's. And so I feel like I'm in that 2 McDonald's space where I have to run around and do a lot of things myself because I don't quite have the revenue yet to hire. And I feel what Jered was saying about that, his inflection point going from 50 units in small properties to buying a 42 unit. Jered, can you speak to some of your tips and tricks for adding value with apartment complexes?
There's the very obvious. I mean, value add is like the key term that everybody loves, and there's the very obvious ones of like, can you raise the rent? But there's all the smaller components that can make up value add. So any way that you can cut expenses and any way that you can increase income is great. You know, can you sub-meter the water? Can you put in washers and dryers? Can you put in a vending machine? But I will say the things that seem to have the biggest impact, and Kurt might be able to back me up on this, is I can put in a vending machine in the laundry room and make $50 a month, and then I'm going to go to do a cash out refinance, and that lender's going to be like, I don't care about that because we don't underwrite that, and the next person isn't going to do it. The thing they really care about that I've had the biggest bang for my buck is rental increases and cutting utilities. So like that's the easiest thing for the next person to also inherit that and continue it. And so I, with my construction background, I come from a construction background, we buy these things and we look to renovate, to increase rent, and then we look for efficiencies in the utilities. Can we reduce water consumption? Can we reduce electricity consumption? Can we put in new boilers? Can we put in new furnaces? Can we put in new hot water heaters? And when you do that, there isn't a single lender or buyer that will question that value. Now, if you go and put a vending machine in the laundry room, the next buyer or the lender might say like, well, I don't want to restock that, or I don't want to, keep people from breaking into it. I'm going to ignore that income. And so adding value, not every dollar of income added or every expense cut is equal in value add. And so that's something I've learned as we've continued to execute cash out refinances through value add strategies.
I would agree with that, specifically from the lending standpoint. A lot of times, lenders are not making a lending decision based off of how much in late fees you collect or laundry income or vending income. A lot of that gets stripped out. It doesn't matter for the appraisal most of the times either. Yeah, you might get some FF&E value if you do own the equipment outright. But like you said, Jered, one big thing that's really happened, I would say over the past, I couldn't tell you how long, but that has always made a big impact. If you couldn't sub-meter essentially, or I should say separate out boiler to, each thermostat, because it's too expensive for some of the smaller stuff, instituting like a RUBS program, or I know there's some companies out there that will do it for you for the bill backs. They'll divide the bills based off square footage and do bill backs to tenants. That's helped because you're cutting those utility costs down and you're increasing your bottom line, like you said, forcing value. Mm-hmm. So you're right on the money.
Yeah, and I don't think those other items are wrong. Like the laundry room vending machine, I don't do that. That just takes too much time and effort. But that's a great way to increase cash flow, especially if you're smaller and just beginning and you're just like, I'm going to squeeze every cent out of this property. Then do it. But you also have to realize that the next person might not. And they're not going to underwrite with that in mind. Like you can go cut your own grass too, but you're not going to cut it once I buy it. So like I'm going to back that out or add that expense in. And so adding value is different than adding cash flow. And I would say that's something I didn't fully get in the beginning. For me, it was like every dollar is the same and I need to, do these things like add these little ancillary income, and it would fizzle out once I got to trying to strip equity. And so utilities and rent is the main focus.
You're hitting some very key words there, Jered. When you say, stripping out equity and the difference in cash flow and adding value, if you're an owner operator and if you self-manage your property, that doesn't mean from an appraised value, you're not going to get a hit with a percentage for a management fee, because when you're stripping out value, it comes down to what it appraises out at. You may do this today, but who you're going to sell it to is not going to do that. It's always the assumption that the end user is going to have a professional management in place and pay a management fee. And that seems to be one thing that usually gets lost when you do that value add towards like some type of cash out refi equity piece or from the appraised value. And I'm hoping it goes along with what you're saying. There's certain things that count, certain things that don't count. You can cut your grass all day long. You're still going to have a maintenance and repair fee. You can self-manage your property all day long. You're still going to have a management fee built in for future valuation when you go to do that. But like you said, those are things that you do have to consider.
One thing I will add that goes along those same lines, as you focus on your operations, as Jered has talked about so much, focus on your leasing systems and the experience that a prospective tenant is going to have when considering renting from you, starting with what they see and how they hear about your property. I have a 24 unit where I was told by multiple people, including multiple previous owners, that the rent in that spot for my units will never go above $575. Well, everyone who said that was also only attracting tenants with a sign with a phone number. And so the only people who ever knew that there were apartments available there or ever inquired were people who drove by or walked by, saw the sign with the phone number, and called to ask if there were apartments available. When we started taking professional photography, when we cleaned up the place and did some serious improvements to improve the quality of life and lifestyle for our tenants, when we started putting our apartments for rent online, imagine that, it's 2019, it's 2020. Professional photography, making sure that we were responding to inquiries quickly, making sure that we had a good process for handling prospective tenants and getting applications in and doing showings. Our rents right now, we have pet rent and we're pet friendly. Our base rent is $650. We were told it would never be higher than $575. And the rents vary right now between $650 and $715, depending on a few different factors. So make sure that the leasing experience and the experience your tenants have living in your property is a good one. And make sure that you're doing things in your marketing that will attract the right tenants.
Yeah. So I'm going to piggyback on that and then tie it into what Todd asked and probably the general topic of this conversation. One thing that we did that a lot of people thought was strange was all of our signage that we buy when we buy these apartment complexes, we buy new signage, we put it up. Nowhere on that sign will you find a phone number. We just have a URL. And our logic behind it was this is a method of screening. The person who knows how to drive by a sign, take down the URL, go to the website, make an inquiry, and apply online is more employable. And now more than ever, those are the strong people who know how to use the internet to a minimum standard or own a computer or own a smartphone. These are the people who are currently still working, or at least more of them. And so what Slocomb said for leasing is so important. What Todd asked about adding value, my collections are still very strong for a lot of reasons, but one of them because of screening. And one thing we did with screening was we eliminated the phone number to eliminate people who were potentially easily laid off. And we got a lot of pushback from that from prospective residents at first. Like, why don't you have a phone number? That's weird. And it's like, well, you get the phone number once you move in, but for right now, like, can you use the URL? And that screening in the leasing experience has paid off in protecting us through the COVID-19 pandemic because of our quality of resident.
That's awesome. Well, we've definitely gone over time by a significant margin. There's been a lot of really good information, though. I hope you guys are taking notes. Kurt, Jered, thank you very much for joining us and adding as much value as you have. And to all of the attendees, very much appreciate you taking the time to be here, ask your questions, check this out. The last Tuesday in May, which off the top of my head I believe is the 26th, our speaker will be Ryan Nash, who's a friend of mine who, for the sake of titling this, we're going to call a lifestyle house flipper. He built his house flipping business in Cincinnati. He's from Cincinnati, born and raised, to the point where he could go travel for 4 to 6 weeks at a time, be on the other side of the globe, and all of his flips were still happening. He was still buying properties, getting them renovated, and getting them sold while canoeing through lakes in Thailand, or hiking the Alps, or being in all of these crazy places doing these crazy things with his business still running itself in Cincinnati. So if that's a story you want to hear or someone that you want to learn from, be sure that you check us out next month as well. Thank you all for being here, and have a great May.